Hello everyone and welcome. My name's Elliot Gu. I'm founder and editor of Smart Bonds. And today I want to talk about three specific reasons why I believe all individual investors should consider putting a portion of their portfolios into bond, preferred stock, and credit market exchange traded funds, or ETFs. Now I do realize that idea, that concept, is a little unconventional these days. After all, the mainstream media seems to really hate bonds right now. And a lot of individual investors I speak to are convinced that returns in the bond market have been terrible in the last couple of years, both in absolute terms and certainly relative to the stock market in the S&P 500. And I think there are a couple reasons why, and I'm going to show you why both of those ideas are total misconceptions and completely untrue. But I also think that there's some reasons why this is the case. One is that, of course, in the mainstream media, they're always going to chase, and financial media as well, they're always going to chase sort of emotion and excitement, and they're going to always tend to focus on what most individual investors own or can relate to. And in most cases, that is stock market, and in particular, it's the S&P 500. And I think the second big issue out there is that a lot of individual investors, and really even people in the media, conflate the idea of the bond market with treasuries, with U.S. government bonds. They seem to think that the only bond investment out there is treasuries. And of course, that's totally not the case. And a related issue, if you buy the S&P 500, you're in a sense in a momentum play, right? It's market cap weighted, so the companies that have the largest companies also have the highest weight in the index. So when